Well, Peter, thanks very much for having me on one of your conferences again. It's always a pleasure, and they're always very interesting. So I hope this one is going to be no different. Um, Obviously, you can see my slide, and I hope it's coming through fairly clear. And most of your listeners and clients will know that we have 3 listed investment companies, which I've spoken about many times, if not at your conferences or on your television program when you used to run it. And the 3 are flagship investments: ECP, Emerging Growth, and Global Masters. The one that I'm going to talk about pretty much today is flagship investments, which is, as it says, it's our flagship. It was quoted in 98, and interestingly enough, I was looking at documents required to list it, and in those days it was 28 pages, and these days if you want to list something, it's like 128 pages, and I'm not sure retail investors are any better off, but anyway, we'll leave that for another day to argue about that. The portfolio is, as you know, run by and managed by Pohl & Co. And the investment comprises capital efficient companies with without excessive financial leverage and a sustainable competitive advantage, which is a kind of a buzzword these days, but I'll talk a bit about it later. But those enable them to expand the economic footprint and maintain these characteristics into the future. And it's that future part that's also very important when you look at the anomalies that we tend to address in the marketplace. The interesting thing about flagships is that there's no ongoing management fee. It's Pohl & Co. has only paid a performance fee. So what that means is that if we don't outperform the benchmark, we get paid nothing. And that means no money to administrate the company or anything. So the performance fee is the last thing that's really paid. Dividends are paid first to the shareholders, and the performance fee is calculated and charged annually on the performance over the 12 months. The investment objective of flagships is threefold: to achieve medium to long-term capital growth and income through investing in a diversified portfolio of listed Australian companies. So we don't have any unlisted investments. We might take something that's about to list, but generally everything is listed. The primary objective is to preserve and enhance the NTA backing per share. And I'll show you a chart in a minute that confirms we've done a pretty good job at that. And more importantly for your audience is to provide shareholders with a fully franked dividend, which over time will grow at the rate of in excess of the rate of inflation. If you have a look at how the portfolio has performed, clearly we're a long-term manager and we're buying growth companies. So one has to be invested for the long term, which is what everybody keeps talking about. So then one has to see how we've performed since inception. And since inception, the portfolio has produced 13.5%, and that's through the GFC, the market crash, various fluctuations in the market. Those are all in that number. And the index, the accumulation index, the All Ords, has done 8.8. So a substantial outperformance versus the All Ords, the accumulation index, that is. And if you just look at the ordinary index, certainly it's a lot better than that, and certainly a lot better than the bank bill rate, which is obviously what one has had returned over cash over that time. The ASX produces a table which comprises a lot of managers, and I've highlighted the major ones that you will be familiar with. WAM Capital is really well known to all of you, and Jeff has done a fabulous job with that company and marketing it. You can see it trades at a premium, whereas we trade at a discount. But if you have a look at the 1, 3, 5-year numbers from the table that the ASX produces, you can see that we're certainly out there as being one of the top managers in the space. And it's not only in the ASX survey, but if you look at the Morningstar survey, we've been in the top quartile forever. It doesn't matter which period you look at it, 1, 3, 5, 10 years since inception numbers, we've been in the top quartile. So the team that I have assist me with producing excellent results. From a shareholder perspective, how have we gone with having the dividend exceed the rate of inflation? And that's the chart of actual dividends paid over time. And since inception, the dividend has grown at 5.1% per annum, and CPI has been 2.5. So if you're invested in 1998, the dividends you would have received have grown in excess of inflation, which clearly for retirees, that's really important. Why am I talking to you today? Well, we have recently announced a convertible note offer. This is the first time in this space for us. And obviously the reason is what's going on in the fixed interest market. So this particular note offer is unsecured and it's redeemable at the end of the period, which is 5 years. We're raising 20 million, which is a fairly small amount of money by comparison, but certainly we're comfortable with that. The offer price is $2.70, which is exactly the same as the last NAV that's been declared. So there's no dilution to existing shareholders, which is something that I've been paranoid about forever. It's paying 5.5% initially, and then there's a step up if the interest rates in the market generally have gone up to 6.5%. And then, as I said, it converts 1-to-1, and the maturity date is in 2026. There's a priority offer to existing FSI shareholders, and there is a broker firm offer as well. And why are we doing this? Well, firstly, obviously, we want to grow the size of the company, which is, we've got a portfolio size of about $70 million, and this additional 20 gets us to 90. And anybody who knows what research houses and asset consultants want to see, they want a company of at least around about 100 million before they'll look at it, irrespective of the good performance that we've shown. That has been a problem. Gives us increased visibility to the stockbrokers as well, because it starts to get a size where they can certainly get their clients interested. And it reduces the MERs and ICR ratios, as would clearly happen with more FUM under the belt. It does also expose us to investors who are interested in fixed interest, but certainly we're hoping to widen our shareholder base. A little bit about the fund manager. If those of you are not familiar with us, we are an independent boutique. We own 100% of the business. It's not listed. It's owned by the staff. We're currently managing in excess of $2.5 billion, with most of the money being for large institutions. And if you have a look at some of the key findings about us, we're clearly, because we've got a license, we're fully audited, and our GS007 was unqualified, and that's the one to June 21. We've never had a compliance or a mandate breach. We've got no regulatory investigations and no legal proceedings, which are things that I'm sure you would all be interested to know about if there were, in fact, such things happening. As I said, we've always been in the first quartile. And in terms of the team that sits behind me, we have an outstanding team culture, all younger people compared to me of the same age. There are the mugshots, I believe highly talented and very energetic, and certainly think outside the square when it comes to finding investment opportunities. What is it that is the cornerstone of our investment philosophy? Well, it's all about the business that we invest in, and we believe those economics drive the long-term returns. We're trying to value potential, not just performance, and we're always choosing high-quality growth businesses. The key thing is that if you start to look long-term, what you're trying to do is ignore temporary market turbulence. And in fact, when the markets get smashed, like they were at the start of the COVID-19 epidemic, we employed a lot of capital and have had excellent returns, as you would have seen from that chart, where our 12-month figures through that period were north of 40%. What do we exploit? Why is it that we are able to actually produce outperformance? Well, there's two real anomalies that we find in the market. One is the market tends to undervalue quality growth. Not always, but at some instances, it does undervalue that. And we've seen that in periods over the past 18 months at the start of the pandemic. And then there was a bit of a shift from growth type assets to value, as people thought the growth assets were becoming too expensive. And then through reporting season, which we've just seen, where the quality companies' earnings have been substantially better than anybody thought, now we've seen that part of the market run again, which has been obviously to our advantage. The other one is time arbitrage. So if you think longer term, you don't get caught up in these short-term fluctuations, as I said. And obviously, it means that there's better returns for our investors at the end of the day. We have what we call the 6-pillar process to analyzing companies. And you can see them there by the 6 screens. These days, there's a lot written about sustainability, and it's become more of a buzzword. It's been in our process since day one. And all of these 6 pillars clearly enable us to analyze a company to assess the sustainable competitive advantage. But the sustainability one, to what's going on in the market, and I'm sure questions will be raised at this conference, we have 2 circles or pillars that kind of deal with sustainability. One is clearly the management assessment, and part of the sustainability of business, or the the ESG and sustainability is the quality of management and how they run the company, and that's clearly important. And then the second one, sustainability, I can run into that in detail in the panel session, but that is really where the heart of sustainability is examined, and there's some very interesting nuances that we follow in that respect. As a result of this focus, we have excluded the following sectors almost since inception. Well, since inception of this business. We don't own any gambling stocks, pornography, tobacco, weapons, petroleum, old forest logging. We did own BHP years and years ago, which clearly has a petroleum leg, but more recently, over the past 5 years, we haven't owned that. And if you look at our carbon footprint, it's substantially lower than the index for both the Growth Companies Fund and the Emerging Companies Fund, where it's 61 tons versus 153 in that space. And for the emerging companies, is 8 versus 168 tons per $1 million of capitalization. So we're way below the benchmarks, and clearly something that is of interest to investors these days. We are signatories to a couple of worldwide organizations. UNPRI is one that a lot of people have subscribed to over the years, and they do a great job in tidying up ESG criteria. And the other two you can see there, and Ownership Matters is one that clearly looks at what management are doing and what executives and directors are doing. So the benefits to the shareholders of this convertible note are: one, reduced share investment risk through a quality portfolio with a long-term track record since '98. Top quartile performance, irrespective of which research house you pick. There has never been any gearing on the balance sheet. This will be the first element of gearing. And as I said, it's 20 million versus a current portfolio size of 72 million. It's managed by a professional outfit, and there is anticipated growth in the fully franked dividends over time. And if you look at our balance sheet, we've certainly got the reserves to do that. There's no fixed management fee. It's purely a performance fee for the manager. And there's a 1-to-1 conversion ratio of notes to shares. The timetable is in front of you. It closes at the end of September. And we think that they'll be issued around the 1st of October, all things being equal. So thanks for your time. And again, Peter, thanks for inviting me to be at your conference. And I look forward to the 2 days of debate. And I'm sure you'll hear some interesting viewpoints over the period. Thanks a lot.